Consistency is an accounting principle, and the main trick with it is to remember it's basically the same as comparability. You just want to make sure when you get a question, you use the one that they're asking for. So if they're asking for a qualitative characteristic, then you'll use comparability. If they're asking for an accounting principle, then you better use consistency. So how do we define it? Pretty similar to comparability. We just say the accounting methods used must be applied consistently from one period to the next, and this allows comparisons of the firm's performance to be made over time. So applying consistency means we can compare results, so that's why they're so related, these two concepts. If constant changes were made to how items are recorded, comparisons over time will be difficult. So let's say we bought a property for $500,000, its value today is $600,000. So how should you value it? Well, there's no right answer. It all depends on your theory that you're going to apply and your opinion. So maybe in year 1 it was valued at its purchase price, then in year 2 it was valued at its current value, year 3 current value, and then in year 4 it went back to purchase price. That is wrong. You can't compare those results. For instance, it looks like we've had a really good result from this year to this year. We didn't do anything. The value of the property just went up. I wouldn't be able to really compare my profit or my assets from the year before. And on the other side, from here to here, it looks like we would have made a loss. But I'll keep it at its price, because otherwise I haven't really sort of performed any worse. It's just that the value of the property went down. It wasn't really anything to do with me. Also, it means if I'm valuing something, like I've got 3 buildings, building A, building B, and building C, I use the same method. So as long as you value them all at purchase price, that's fine. Or if I value them all at their current value today, that's fine. What's not okay is sort of valuing one building at its purchase price, another at its purchase price, and then the third one at its current market value. That's not consistent. I'm using different accounting methods and I can't compare my results. Looking at an example, we're going to use the same example we did when we looked at comparability earlier, which was the business has depreciated all of its vehicles using the straight line method. The firm's accountant has advised that for vehicles you should use reducing balance. Explain whether the owner should follow the accountant's advice. Now this is definitely true. You should actually use reducing balance for a vehicle because it's going to earn less revenue as it gets older. However, if we're following comparability, that should say consistency. So remember not to do what I said don't do what I said not to do, which is get the two mixed up. So you should write consistency if we're doing an accounting principle. We'll define it. The business must use the same accounting methods over time so results can be compared. And then we'll relate it. So in this case, keep using the straight line method. And specifically, you really need to mention what it is you'll be able to compare. If I keep using the same depreciation method, I'll be able to compare the depreciation expense and the net profit. That's a really important part to put into your answer when you're doing your relating.